Hello and welcome to Advanced Charting Techniques. My name is Ben Watson. I'm an education coach and senior manager, and this is going to be another great webcast from Schwab Coaching. I am joined by my good friend John McNichol out there in the chat. I'm glad to have him with me, helping to support your questions. And welcome to all of you. Thank you for joining us today, whether you're joining us in the live version or the recorded version. I'm glad to have you here with us. And we're going to talk a little bit about charting beta today. We've talked about beta weighting. We've talked about balancing the sensitivities of our portfolio, and that's what this is going to be about. But we're going to take it from a charting perspective, and then we're going to use that idea to build some additional tools that might be helpful in developing a diversified and portfolio that maybe matches what a trader's expectation might be. So before we get into that discussion, let's talk about a couple of quick housekeeping items. First and foremost, again, thank you for joining us. You've got that chat there. Make sure that you select live chat instead of top chat. Otherwise, you might miss some of the conversation there in the chat box. If you're in the recorded version, drop a question or a comment in the comment section. That works as well, and we'll get back to you on that. Now, from a standpoint of a couple of other housekeeping items, just really quickly, everything we talk about simply for illustrative and educational purposes only. It is not a recommendation of any particular security or pattern or strategy. Now, I read this simply from the standpoint of understanding that we're going to be option adjacent in this discussion. We're not going to talk about options, but we're going to talk about some of the reasons why options might be used in a portfolio. And I'll talk about that as we get into this discussion, but it doesn't mean we're talking about option content. But just a quick reminder that options carry a high level of risk. They're not suitable for all investors. Make sure you're aware of the characteristics and risks of standardized options before considering any option strategy. Now, we're going to talk about some technical analysis. We're also going to talk about statistical and quantitative analysis in this discussion today. All of those are theoretical in nature. None of those are guaranteed. Schwab doesn't recommend the use of technical analysis or really any one specific method of market analysis as the sole means of investment research. We're going to be using the Thinkorswim desktop software platform today, specifically the paper money version. It is a great learning environment. It's a great sandbox to play in. Doesn't guarantee future success out there in the real world. And there are some things that the paper money platform does not do that a live trading platform will do. Namely, one of those things that we're going to talk about today, and that is allow the capability of using studies, technical or otherwise, in searches and scans. So I'll point that out as we get to that discussion in this direction. Now, one last thing I will say is this. We're going to be talking about diversification and the idea of balancing a portfolio. Remember, the diversification is not a guarantee that a portfolio or a position will not see a loss. It doesn't eliminate market risk. It doesn't guarantee against down moves. Diversification is simply another way to help manage risk in a portfolio. So we're going to talk about the technical concept of charting beta or portfolio volatility, if you will, or stock volatility, if you will. And we're going to talk about the way that we might use some of these technical indicators, and we're going to look at some examples, and we're going to look at an example portfolio that might help us to understand this concept a little bit better. So let's do this. Let's pop over to the Thinkorswim desktop software platform really quickly here. And as we do that, oops, let me find, there it is right there. I'm just going to quickly remind everybody to click on that subscribe button down at the bottom of the page. That subscribe button, you know, for those of you that are brand new to YouTube, there are some of you that are. I mean, this is familiar to many, but not to everyone. So this is why we give you the reminder. Clicking on subscribe doesn't cost you anything. It just means that you're connected to this YouTube channel. It means that you have the ability to set alerts for new content that comes up. And it has a couple of side benefits. One is keeps you connected to this community. And number two is it pops this content up for you and for other people at the top of the algorithm. So clicking on subscribe, clicking on like, helps us out. It helps you out. It's a nice symbiotic relationship. So we're taking a look here at the Thinkorswim platform. And I've segmented my portfolio here and the positions in my portfolio into a variety of different groups. And we've got some great webcasts to talk about how to do that, how to set up those groups. So I'm not going to go into that at this particular point, but the group that I've got set up is this beta weighting group. And so in this group, I've got a bunch of stocks, and these stocks have kind of different characteristics. I've got some technology stocks in there. I've got some industrials. I've got some communication services, which is also kind of a read on consumer discretionary. I've got some what would generally be considered to be consumer staples, the Coca-Cola position here, Walmart, kind of in that halfway between staples and discretionary and retail side of the equation. So there's kind of a relative balance of positions. You notice I've got just kind of some basic quantities here. I've got 100 shares of each one of those. And so this particular portion of my portfolio, not doing so poorly over the course of the time that these positions have been in place. That's not the big key here, right? We know that these individual stocks, we know that this group of the portfolio can and has gone down as well as gone up. Right now, today is a pretty good up day so far for most of the stocks in this portfolio, with the exception of Boeing, with the exception of Amazon. Vistra is going up a little bit. Walmart, Disney, Coca-Cola, all seeing some gains today, which is great. But what I don't know is kind of the balance of this portfolio and how this portfolio relates to the performance of the S&P 500 or the performance of a benchmark. So I wanted to talk about the concept of beta. And we've talked about beta in a couple of different contexts before. The aspect that I want to look at in this particular case, and that's thus the name for this particular group, beta weighting, is the idea that beta is a measurement. If you want to think about it that way, beta is simply a measure of an individual stocks. If we want to look at this from this standpoint, there are other ways to look at beta. But the way that we're going to look at it is that beta is a measure of a stock's volatility compared to the overall market when we benchmark it against an index, right? Like the SPX. So let's take Disney as an example, just kind of out of the middle of the box here, the middle of this particular group. There's no other reason why we're talking about Disney other than the fact that it is kind of falling in the middle of that group. This is simply for illustrative and educational purposes only. I like the fact, though, in the context of this discussion, is that Disney has made this big move to the upside off of an earnings announcement. So it's kind of historical volatility. The volatility or the range in which it's moved has increased substantially. But a lot of the way that we've looked at volatility before, especially in charting volatility, or we look at it in the context of other strategies, is we look at something like implied volatility as a measure of expected move. That when implied volatility is high, there's a bigger expected move. When implied volatility is low, there's less of an expected move. And so we typically tend to see those run-ups in implied volatility prior to an earnings announcement where there's new information coming into the system, right? We could come back up here to the chart or the little flask icon up at the top of the chart, and we could include, in addition to implied volatility, historical volatility, right? And historical volatility, as opposed to implied volatility, is the move that the stock has made that it's realized. So this is sometimes called statistical or realized volatility. And what I'm going to do, just so that we can kind of see this comparison, is I'm going to take historical and I'm going to lay it over the top of implied in the same box. And you can kind of see this relationship that oftentimes implied volatility tells the story ahead of time. Historical volatility tells the story after it's happened. And not that implied volatility predicts, but implied volatility suggests what the market is expecting. So when we start to see this relationship, right, of historical versus implied, that gives you an overall picture of how this individual stock, or any individual stock, it doesn't matter if we were to change the symbol here, right, we'd see the same thing. How this individual stock that we're looking at behaves kind of relative to itself, right, in terms of volatility. What's kind of that range of movement? And from these indications, right, from historical volatility, implied volatility, we get a lot of technical studies. We get things like ATR, average true range. We get things like the parabolic stop and reverse. Historical volatility is a component of that. You get things like Bollinger Bands. You get things like Keltner channels. All of those kind of technical charting tools that Cameron's talked quite a bit about in these webcasts derive their data from this historical and implied volatility comparison. In addition, and again, this is where I'm saying that we are option adjacent, but we're not going to get into option strategies. We're just simply talking about this. That the option market is what drives this implied volatility calculation. And so from that implied volatility calculation, options traders may derive things like expected move and probabilities. That's as deep as we're going to go into that part of the content. But that's, again, kind of that expectation. And so you see this relationship. So this is, once again, though, relating that volatility expectation to itself. I have no idea, simply looking at this historical volatility, implied volatility comparison and discussion, I have no idea how volatile this individual stock is relative to other stocks, number one, and number two, relative to, say, for instance, the market, the benchmark. So if this were the only position in my portfolio, if Disney were the only position in my portfolio, this would be enough, right? Because then I could see, oh, I know that it's more volatile. I know that it's a little bit less volatile than it has been. That can tell me when there is perhaps greater or lesser risk of movement, right? But when I start to combine this position, because I know that in this particular example portfolio, I have more than just 100 shares of Disney, that risk now becomes kind of magnified simply because now I've got a lot of other stocks to deal with, right? And I could look at each one of them individually. I could come up here to the chart and I could put in KO, Coca-Cola, and we can see what Coca-Cola looks like. And I can say, well, objectively, it probably looks a little bit less volatile, even though it's been moving. It's a little bit less volatile than Disney. If I were to look at, say, for instance, Amazon, AMZN, I could say Amazon, well, gosh, Amazon looks a lot less volatile than Disney, but do I know if it is or isn't? So now we've kind of come up with a commonality, right? We've got to come up with some kind of common relationship or a common coefficient to help us understand that relationship. And we've done this before for the context of hedging. If you've been with me in my index options webcast, if you were with me in the previous series before that, which was our protective strategies webcast, if you were with me anytime on Tuesday mornings when we teach futures, we talk about this concept of hedging portfolio volatility and movement. So one way that we could go about doing a kind of a comparison, right? We could put on any of these charts. I'm going to go back to Disney, right? DIS. We could put on this particular chart a study that might give us some information about how this particular stock moves in relationship to something else, a benchmark, for instance. So what I'm going to do is I'm going to come up here to the Flask icon. And the first study that I'm going to put on here, I've already got it on here. You can find it over on the left-hand side if you just type in BETA, beta, right? You can find that beta study. And I've put beta on here, and I'm just going to open the eyeball for that beta study. This is so great. This little tool right here on the Flask icon where you go to edit studies and strategies, and you can close the eyeball and take one of those studies off and not show it. And then when you want to show it, you can turn that on. So what I'm going to do is I'm going to turn historical and implied volatility off, but I'm going to turn on beta. And I'm going to click on apply and OK. And now the only thing I have down here is beta. So I want to kind of explain it this particular way. And I'm going to open up my left sidebar because I kind of typed this in just a few minutes ago as we were talking about this. A stock or an instrument with a beta that is approximately equal to 1 matches the movement of the market. right? Matches whatever it is that we are beta kind of equating to, right? So market movement in this particular case, we're going to make a fiat assumption is SPX, okay? So a beta of 1 in this particular case, or just about 1, give or take a little bit, matches the market movement as a whole. Beta less than 1 means that the stock is less volatile than the market. And a beta of greater than 1 means that the stock is more volatile than the market. So for instance, an example, a stock that had a current beta of 0.5, less than 1, means that it's about half as volatile as the market. A stock that has a beta of 1.5 greater than 1 would be a stock that is 50% more volatile than the market. If the equal volatility is a beta of 1. We all on the same page here at this particular point. Okay, well, now we're thinking, well, okay, so what? What does this mean, right? Why do I care about this? Well, what I can see now objectively, and what kind of flies in the face of what we see in terms of price movement, is this relationship of volatility to the market, right? Because take a look at this particular point. So here's kind of that one level. I'm just going to draw a line. I'm going to grab my line tool here. And I'm going to draw this trend line right here. I'm going to use this one right here, this price level tool. And I'm going to find 1. And 1 is just kind of right there, right? That's 1. It's 1.01. If I were to do this, I were right click and I were to edit properties, I can make that 1 exactly, 1.0 exactly, and we'll click on OK. There's 1.0 exactly. All right, and we're going to get to that, Thaya. Don't worry. We're coming to that. I want to talk beta first, then we're going to talk about fast beta. Because faster is better, right? Not necessarily. We'll see what that looks like. All right, you can see that generally, this is within, a couple of decimals of that 1.0 level. So it suggests that Disney typically moves in relationship with the market, right? That's interesting in the sense that what happened here in December? Well, holy cow, the stock itself, look at what was going on with the stock. We had an earnings announcement. It had a gap up. It had this big solid run to the upside, and yet its beta was dropping. In fact, its beta in this particular case went down to minus 2.9. So I will round that to minus 3. So that would mean that it was 3 times less volatile than the market as a whole? It made a huge move to the upside. Well, that tells us something, right? That relationship tells us now that maybe something was going on with the market that Disney wasn't seeing, or Disney was moving in opposition to. So if the market was moving down and Disney were moving up, that kind of gives us that kind of anti-volatility perspective. So what I'm going to do here as well is I'm going to come up here to my Flask icon, and I'm going to type in the words COMP, comparison. Now, you notice that this beta is related to SPX, the S&P 500. So we're going to do the same comparison here. I'm going to choose comparison, and I just want to simply show the SPX. And I'm going to click on apply and OK. And notice what was going on here. Well, wait a second. The SPX was also going up pretty quickly here. The SPX was going up and then started to move down, but Disney was moving less volatilely. If you remember what was going on in November, December, right? In November and December, the leadership of the SPX was starting to fall off. We were starting to see, some of those tech leaders, the Mag 7 names, starting to fall off. So the volatility, the overall volatility of the SPX was growing. Disney's volatility was staying kind of the same, But relative to the SPX, it was falling off because it's kind of that relative relationship. So if this is staying the same, beta and that 1.0 level, that means that those are staying fairly closely related to one another. But if the index, the SPX in this case, is getting more volatile and Disney's staying the same, well, that's why we might see something like this. Or if Disney's getting less volatile and the market's getting more volatile, that may be also the reason why we're seeing this. So if the two are moving away from one another, if the one is staying the same and the other is moving away, or vice versa, wow, we might see those big changes in beta. So what does that tell us? Well, if we're trying to build a diversified portfolio, the kind of E plus ultra of diversified portfolios, kind of this modern portfolio theory idea, is that you have non-correlated movement. You have stocks that move in a different fashion, either more or less volatile than the market. And if you have stocks that move in a less volatile fashion, that provides some diversification when the market begins to move quickly. So if you find that the average volatility of your portfolio is greater or lesser than the market, you can adjust your portfolio. You can rebalance your portfolio to add or subtract that beta, that volatility, and have that portfolio match more closely a balanced portfolio or one that tracks the market. So that's kind of the idea, right? Now that we have the concept of how we use the tools, what we see in the tools, one other tool I'm going to put on here, and this goes back to Thay's question. I'm glad you asked that question, Thay. So I'm going to go back up here to the flask icon, and I'm going to undo the eyeball. So I'm going to close down comparison. I'm going to keep beta here. I'm going to do fast beta. And I'm going to open up the eyeball for fast beta, and we're clicking apply and OK. And you can see that fast beta is pretty close to what we're seeing in regular beta, right? Now, we're seeing a little bit of a flat line right here out to the front because I've got some space on the hard right edge of my chart. This is empty space looking out into the future, so it just flatlines fast beta. But here's what fast beta is. Fast beta uses a moving average. And John, thank you for putting that definition down there in the chat, and I appreciate that. Fast beta is simply same kind of calculation. It simply uses, instead of a simple moving average, it uses a weighted moving average. So this would be the difference between, say, for instance, using a simple moving average on price versus an exponential moving average on price. It's going to be more reflective of current movement. It's going to be, however, maybe more sensitive to false signals. So we've got equivalent betas here, right? Beta and fast beta. And what you'll find more often than not is that traders and investors will use fast beta because that exponential moving average takes out some of that anchoring effect. You still get some of that anchoring to previous moves, but the exponential moving average is going to weight recent data more heavily. And as John points out in the description here, more sensitive to recent changes. Now, let's kind of go back to our portfolio here. I want to go back to our monitor tab, and I want to look at our portfolio. So what we could do is we could come back in here and we could go to our gear icon, and I could go to this dialog box, and I could add in a column that's fast beta. Okay, so let's use fast beta in this particular case, fast beta. And we're going to click on OK. And now what I've got is a column that lists the fast beta numbers for each one of these positions. Okay. And I can see that, look, I've got Vistra, which is 2.4 times the volatility, fast beta volatility of the market. Boeing, which is a little bit faster and a little bit more volatile than the market. Amazon, a little more volatile. Delta Airlines, a little more volatile. Disney, which is right about at the market. Walmart, which is slower than the market. And Coca-Cola, which is a lot slower than the market in terms of that movement. And if I wanted to, I could even do this. I could come over here and I could say, look, okay, let's just do this kind of really quickly back of the napkin. 2.44 plus 1.67 plus 1.34 plus, we'll just do this really fast, 1.32 plus 1.03 plus 0.79 plus 0.14 gives me 8.73. That's the total aggregate beta numbers for the positions in this portfolio. And we've got 1, 2, 3, 4, 5, 6, 7 positions. So we're just going to take that 8.73 and we're going to divide it by 7. And that's going to give us our average beta or average fast beta for this portfolio. So that's 1.24. So what that says is that this portfolio moves about 24% in a 24% more volatile fashion than the market as a whole, right? So this is a little more sensitive. So what I could do then in changing that sensitivity to the market is I could change a couple of different things. I could add another position in here that has a slower fast beta number. I could add more of a position that has a slower fast beta number, or I could take out of the portfolio something that has a higher fast beta number to come up to where I want that portfolio to be. If I wanted my portfolio to just match, I didn't want to outperform or be more volatile, which we could equate to risk. If I didn't want my portfolio to be more risky, thinking about movement, than the market as a whole, I could reduce that sensitivity or that volatility by reducing my average fast beta. If I wanted to add exposure to my portfolio, I could add more of a position or add other positions that gave me more beta, that potential for volatility. Now, again, remember, diversification, we said this before, diversification does not remove risk. It helps to smooth out that risk. It helps to manage that risk, but a diversified portfolio is not a guarantee against the market moving down. My good friend Pat Mullally used to say this all the time. He said, when they raid the house, they get everybody, including the piano player, right? And sometimes the whole market goes down. And we've talked about that before. We've seen it happen recently. So in terms of diversification, we could change this portfolio. Now, here's the thing. Do I know, in terms of how this is related to how I can adjust my portfolio? Well, I could add a position, right? And I'll show you how to do that here in a second, but there's another way that we could do this. The Thinkorswim platform actually gives us a tool that you could use options, Ricebird, for sure. The portfolio or the platform gives us a tool that can help us to kind of come up with a common coefficient, right? So each one of these stocks has their own fast beta number. But if we were to come up with a common coefficient, then I could maybe simplify that process of managing that portfolio. Let's do two things first. Well, let's do one thing first. I'm going to click on beta weighting, and I'm going to do this. I'm going to go to the gear icon over here, and I'm going to add one column. And you've seen me do this before. We've done this in a couple of other portfolios. I'm going to add this column, DELTA, delta. And I'm adding specifically delta, not option delta, because I don't want the snapshot of what the option Greeks are looking like on a option position. I want delta as it relates even to equities. So I'm going to click on OK. And now I've got this column that says delta. And you notice that the deltas here are all 1, delta of 1, right? 100 shares, delta of 1. If Vistra goes up $1, that position gains $1. Vistra goes down $1, that position loses $1. But what I want to do is I want to convert all of these deltas into SPX deltas, and it does that by use of this fast beta coefficient. So I can come up here to where it says position statement, and I can click on beta weighting, and if this little lightning bolt icon is illuminated, that means I'm using fast beta. I can turn that off. I can turn fast beta back to standard beta. I'm going to keep it on fast beta, and I'm going to click on apply. So I've got fast beta turned on, and I'm going to click on beta weighting, and I'm going to beta weight to the SPX. So you remember what we said? we said that this portfolio is approximately, and I did that calculation, this portfolio is approximately 20% more volatile than the SPX. Well, look at our deltas. That's about 20% faster or 20% more volatile than the SPX. If this were zero, that would be equal to the SPX. If it were a minus, that would be slower than the SPX. So if I wanted to slow this down, what could I do? Well, I could add some slower deltas. So I could come back up here and we could go to the chart and I could go to Coca-Cola, KO, and I know this is moving slower than the market. I can see that its beta here, its fast beta at the moment is, if we were to look at today, its fast beta is minus 33.33. So if I were to add some shares to this, I could reduce my portfolio. So I'm going to go back to that portfolio, and that'll give me an idea of how many shares I might need to buy to reduce this amount of sensitivity, right? So we might buy another set. Let's see what happens if we buy 17 shares. Let's go back to the chart. I'm going to right click on the chart. I'm going to buy, and we're going to edit this order, and we're going to buy. Whoops, let me move this over so that we can see it. Let me move my quantity over so that we can see it. I'm going to buy 17 shares. And we're going to click on confirm and send. We're going to make sure that we're okay with this order. We're going to click on, we need to send this to the right group, send this to the baiting waiting group, and we'll send that order off. It filled. Now, let's see what that did to our overall portfolio. Let's go to the monitor tab. And we increased our position here, and it didn't really peel off much of that sensitivity here. In fact, it added a little bit to it. Oh, so that means is, we got to do something else. We've got to maybe find something that has either a slower beta coefficient that we can put in this portfolio to kind of slow this overall perspective down a little bit. Because then we can really kind of get derivative in terms of adding and subtracting individual positions. And that might be difficult to balance that. Again, one of the reasons why oftentimes traders and investors will use options as a means to manage this portfolio sensitivity, if you will. So what I'm going to do is I'm going to go up here to the scan tab. And I'm going to reset this scan tab for just a second, and I'm going to walk you through this. And here's what we're going to do. I'm going to come over here. I'm going to take a couple of these filters out. The first filter that I'm going to put in here is that beta filter. Actually, even before I do that, I'm going to do scan in. I want publicly, I want, primarily a broad cross section. So I'm going to look for stocks that exist in the S&P 500. Now, the other thing I'm going to do, not as a guarantee that these are going to be liquid stocks, but I'm going to come up here where it says intersect with, and I'm going to intersect with the publicly available watch list of companies that offer weekly options. We're not going to trade the options at this point, but I want to be in that neighborhood where, if that were the case, these have weekly options, which are generally a little bit more liquid. So that's kind of what I'm filtering for first. So we're filtering S&P 500, intersecting with weekly. And then what I'm going to do is I'm going to come down here and I'm going to put in, now I can't do fast beta, but I can do beta. So that's going to get us pretty close. And what I'm going to say is I want stocks that have less volatility. So I'm going to say -2 as my bottom side. And I'm going to say, let's do this. Let's go 0.5 on my top side, 0.5. So I want stocks that fall in that area that are not very volatile, because if I were to add a position there into my portfolio, that's going to suck some of that sensitivity out, right? So if I run the scan, now I've got a list of S&P 500 stocks that all trade weekly options. Again, we're not trading the options. We're just using that as a filter here from a liquidity standpoint. And now those are my available stocks. I'm going to do one other filter here. I'm going to add this filter, and I'm going to add a study filter. And I'm going to come down here to the study filter. This is the part that doesn't work in a paper trading account or paper money account. You have to do this in live because this study does not work in the paper money account. So just be aware of that. But I'm going to add average volume. I'm going to say the 50-period simple moving average of volume is greater than a million shares. I want a stock that trades generally most of the time with more than 1 million shares. And I'm going to run that scan, and that filtered my list down. So I've got a list of stocks that generally trade with more than 1 million shares. Now, not surprising, the types of stocks that we have in this list here, right? Hershey, Humana, Colgate-Palmolive, Johnson & Johnson, PepsiCo, Mondelez. These aren't exactly growth stocks. These are generally going to be more defensive, that are going to be slower moving than the market. So we can use this, and we can kind of sort this list. What I can do is I can customize this list, and I can add fast, beta as a column, and I'm going to move it up in the list so that we can see it. Let's grab fast beta. Let's move it up in the list. We'll move it up here to above IV percentile, and we'll click on OK. And let's kind of move this over so that we can see, where did it go? Where did our fast beta go? It may be that I don't have enough columns. Did I hit, oh, you know what I didn't do? Customize. Did I click on OK? Why am I not seeing that fast beta number? Okay. TechZ, okay. So you could be market neutral. You don't have to be. I'm just showing you how to get to this discussion, right? So reducing beta reduces sensitivity to risk, right? It reduces our outlying possibility to risk, right? That's the reason why. Is it there? Did I see it there? Oh, you know what? There it is. Gosh, it's there. It was just too small. Thank you, guys. I expanded the wrong column. Thanks for catching that. I appreciate that. So I can sort this list by my fast beta coefficient, right? So let's make that, here's my slowest up here at the top, right? Dollar General, United Health, ConAgra, Hershey. So let's do this. Let's add some ConAgra into this portfolio. And so I'm going to right click, and I'm just going to go buy, and we'll buy 100 shares of ConAgra. We'll put it in this portfolio just to see what that does. And again, so I'm going to say this. You could do this exactly the opposite. You could search for high beta, right? For a high beta number and add to that volatility. It means that portfolio is going to move faster than the market. So I'm taking it from the more conservative and more prudent side first, and then we're going to go the other direction. So now what I'm going to do is I'm going to say, all right, we're going to put it in that portfolio. We'll buy 100 shares of ConAgra, which should have a slow sensitivity. We'll go back to our portfolio, and we'll look at ConAgra, and let's see if we can beta weight this again. And now we've got that delta here that's kind of reducing some of that sensitivity, right? It's not very efficient to do that. And again, that's why hedging using some other product is a more efficient way to do this. But if you're building a portfolio over time and you're trying to balance that, right, then that's what you're trying to get to, is kind of that balanced portfolio. So we'd have to add more shares of this to kind of reduce that sensitivity. You can see the small impact that has. But if we were to start to add stocks that have a high sensitivity, now you could really start to increase that that portfolio. Now, do you have to beta weight it to the SPX? No. We could beta weight this something if most of the stocks in this portfolio were, say, for instance, technology stocks. You could beta weight it to NDX, right? And now you can see how sensitive this is to the NDX, right? So I asked a great question. I'm going to put this back to SPX, right? And it says, is there an ideal number? That's a really good question. I don't know if there is an ideal number. It really has to do with a couple of things. One, it has to do with your risk tolerance. And two, it has to do with your uh, goals for the portfolio, right? If you are, let's say, for instance, there is an event, right, that could move the market, and you wanted to reduce the sensitivity of your portfolio, or you started to see that the portfolio was becoming much more volatile because an individual stock in the portfolio was seeing a fast beta number that was increasing or a delta number that was increasing, then you could reduce the sensitivity of your portfolio by peeling back some of that position, right? Selling some of that position until whatever event was passed. Let's say it's a Fed meeting or or something like that, and then you could add to that position. If you start to see that, I don't like this, I want a little bit more sensitivity, then you might actually go out there and find some outperformance, some volatility. Now, it doesn't simply mean, though, because remember, volatility cuts both ways, right? Volatility could be both upside and downside movement. This doesn't equate necessarily, a higher fast beta number doesn't necessarily equate into always going up, right? It just means that it moves when things move, when the market moves, this moves faster. So, take that with a grain of salt in the sense that it could move down faster than the market too, right? So that's kind of that perspective. And TechFZ, I think that's kind of where we're getting to is, if you were to see a portfolio that was, broadly more volatile than the overall market, I think that comes with greater risk. That's the perspective here. I'm not a quantitative analyst. I'm not a risk analyst from that perspective, and I'm not a portfolio theory adherent. But the illustration here is that we can, using the tools on the Thinkorswim platform, both the beta and fast beta calculations here on the portfolio, as well as the tools here in the monitor tab in that beta weighting, we can see what that portfolio is doing and we can adjust that portfolio, right? Yeah, thank you, John, for kind of clarifying that and bringing that out. Right? So why do some stocks or options have a delta of NA, right? So a delta of NA means that maybe there's a problem with the calculation with beta or fast beta. So if you're starting to see that with many, some of those stocks that you have in your portfolio that have a delta of NA, maybe look at using either beta or fast beta, change your beta weighting component here, or look for a stock that maybe is a little bit more liquid and has more activity, and that may be one of the reasons why you're seeing that delta individual, right? That change, right? So I think John makes a good point here, right? If you have a less volatile portfolio, you may give up some stronger moves to the upside. But the pro of that, and to John's point again, is that you may avoid some of the volatility if the market moves down. Doesn't guarantee it by any means, but it may reduce that sensitivity. The problem is, and again, the problem is that overall, traders tend to, we tend to herd to one or two positions, right? I mean, think about your own portfolios. You might have had, as we were going into the end of the year, as we were going to the beginning of the year, you might have had a concentration in your portfolio of those tech leaders. And when they started to roll off, that's when portfolios started taking a hit. Now we may get into a position, traders may get into a position where they're so balanced out and so neutral that when the market does start to move up, like it's been doing over the course of the last couple of months, that they're missing out on some of that upside. And so that's part of the process of rebalancing. That's one of the reasons why some traders and investors will rebalance on a quarterly basis, making those decisions quarterly so that they can then adjust for current conditions. If you want to learn more about this idea, there's a lot of different ways that you can do that. This is certainly one of those. But if you want to learn more about beta weighting, one of the ways that you can do this, you can come out to this Trader Talks webcast channel on YouTube, and you can type in beta weighting, and you're going to see a lot of discussions, and this is primarily around hedging, but you're going to see a lot of discussions around portfolio management and beta weighting and understanding that relationship. In fact, I talk a little bit about it here about a year ago, coincidentally, about fast beta and futures and beta versus fast beta. And so how you can make that discussion. And then, hedging, how much trouble are you in, those kinds of things, right? So different ways you can do that. Then the other thing that you might look at in terms of this conversation as well is a webcast that James Boyd teaches. I'm just going to type in the word value. And this is a webcast that James Boyd teaches on Wednesdays, Trading Growth and Value Stocks. And he talks a little bit about this idea of how do you build a balanced portfolio. So a couple of great resources in this discussion. Hey, by the way, while you're here, click on subscribe. Follow us on X. I'm at Ben Watson CS. John is at John McNichol CS. We'd love to have you there with us as well. My thanks for all of you being here, and my thanks to our great production staff for helping out. You guys are awesome. We will see you guys again. I'll be back later for Market Movers at the end of the day today. Take care. Have a great day. We'll see you soon. Bye-bye.